All right. Let's see what we can get going here. You guys jumped on a little bit early to get some stuff rolling. 1 second. All right, you guys. I think I might actually be getting smarter here with this whole Zoom stuff. Hey, Brady, how's it going?
Hey, good. How are you?
Doing good. I just figured out how to, it is streaming to Facebook right now. Last time we had issues with this, but it's going to be recorded and streamed to Facebook.
Okay.
Just to try to get the most amount of people, watching it. And so, yeah, so that's going to be, let's see. There we go. Yeah, so the main Facebook page for the REIA is where it's being live streamed to right now.
Okay.
But as well.
All right. Good deal. Good
And so
deal.
I'm gonna, like I said, I'm gonna start with those announcements, and then also I'm gonna encourage questions. And
Yeah.
so I have the chat for this plus the Facebook live stream chat, and so
Okay.
I'll help navigate those.
Okay. All right. Yeah, that sounds great.
But yeah, I'll start off with some announcements, and then I'll just cap it off on the end as well.
Okay. Yeah, sounds perfect.
Good stuff, man.
And I suppose I'm ready. Yeah. Okay. So it looks like I have share capabilities. Can you see that?
Yes, I have.
Okay. All right. Good deal. I'll stop the share now. I just want to make sure that that was working. All right. Good. Good. I'm excited. This sounds great.
Same here, man. And I'll be doing my best to moderate on, like, I think I have everyone muted and stuff like that.
Okay.
Kind of just go from there.
All right. Sounds good.
Good, good.
I'm going to mute myself and make a phone call real quick.
Yeah, you're good, man. All right, you guys. So we are, I think I have it figured out. But Brady's going to be jumping back on in a minute, and we're going to get started at 6 o'clock. I'm trying to have it on the Facebook as well, but I think for the most part, I am just going to be recording it on Zoom because it's already kicked me off Facebook Live once, and I'm not sure why. Just if you want to make sure you're here and you're not really getting any issues, go ahead and make sure that you are. Brady's going to be. Make sure that you are registered for the Zoom. You can go ahead and jump in now, but we'll see if we can do both Facebook and Zoom. But apart from that, we'll see what we can make happen here for you guys. You can go ahead and jump in now, but all right, hey you guys. So if you are on just the Facebook Live and not on the Zoom, make sure you are, in case something happens where the Facebook Live kicks us off like it just did a second ago, which, hey, I might be a millennial, but I'm not that good of a millennial. It is still live in Zoom. I'm recording it on Zoom, and I'll be able to upload it again in case something happens, okay, you guys? I'm going to go over this in a second, but for those of you on the Facebook Live and for those of you in the Zoom, if you've got, let's see, if you guys have questions, the chat section on Facebook Live and the chat section on Zoom, I'll be monitoring those in case you have questions for myself or for Brady. And yeah, we'll be getting started in about 5 minutes, but just letting you guys know, I'll be coming back with these kind of these announcements and stuff. But yeah, we'll get started in just a few. All right, you guys. Hey Brady, can you go ahead and, if you don't mind, do you mind putting in the group chat a link to your podcast and a link to your book?
Yeah, absolutely. Where would that be? Is that on the Facebook thing?
So right down the bottom where it says chat.
Oh.
Yep.
Oh, yeah. Okay, cool. Yeah, I'll do that. Thank you.
Yeah, no, you're good. All right, you guys, we're going to be getting started in a second. Hey, y'all, keep joining on. We're going to be getting started in just a little bit. See everyone starting to jump on as we get closer. Thanks for putting those in there, Brady.
You're welcome.
I don't know why Facebook Live has been doing weird stuff with me, but I did a webinar, I think last week, and it wouldn't let me live stream, or it like kicked me out of Facebook Live. So I'm recording it on here because I can always just upload the video afterwards.
Yeah.
So I don't know. We'll figure out what that looks like. Hey, you guys, we're about to get started. For those of you on the Zoom and those of you on Facebook Live, we'll get started in just a few, okay? All right, you guys. I know people are going to be jumping on over the next few minutes and whatnot, but we have people who are here with us on the Zoom, and we have people on the Facebook Live. I just wanted to say, hey, you guys, welcome. Thank you for bearing with us as we figure out all of this with the technology side here with the REIA meetings. So just in case you guys, I know last webinar we had issues with Facebook Live. I am recording the Zoom. If for some reason you're watching us with Facebook Live and it boots you off, I just put in the comments on the Facebook Live the link to the Zoom. It is being recorded, and I'll upload it afterwards if for some reason Facebook is being weird and it shuts it down. But I don't anticipate any issues with Zoom. And like I said, it's being recorded. So first of all, you guys, welcome to a Northshore REIA, Real Estate Investors Association webinar. The goal is here, guys, is to continue to give you a lot of content during this time. You know, we usually do 2 to 3 meetings each month. With these webinars and whatnot, I will actually have the opportunity to do, my actual goal is to do more of these webinars, to do as much. And so if you guys just got I think yesterday I sent out the newsletter. Usually I send one newsletter out for the whole month of April, and I'll share about the 2 to 3 events. I'm actually now going to be sending it out on like a weekly basis because, for example, we have 2 webinars this week. Next week we'll have at least 1, maybe 2 to 3 more. And so my goal is to pump out as much content during this time. So just be paying attention to that, okay? So I want to jump off with just a few announcements in the beginning, and then I'll bring Brady on in a few. I know he's the one that we're wanting to hear from tonight. So just a few things. Again, this is Northshore Real Estate Investors Association. A lot of you guys are familiar with us. We host free meetups when we physically can. It's 2 to 3 of them throughout the Northshore each month. But now that everything is going virtual during COVID-19, we are looking to do more. So just stay in the loop, you guys. However you heard about us. If you heard about us from meetup.com or Facebook, our website, you know, whatever that looks like. Pay attention. We'll be posting about every event that we have, and you'll be able to sign up for them or go back and watch the videos. So I'm going to be sharing a few things in the Zoom comment section for you guys to see. I'll do my best to go post it all on the Facebook one as well. But so here's a few things, you guys. So these events, we have, like I said, multiple ones. I'm doing another webinar tomorrow from 10 a.m. to noon. I am going to post that link when everybody starts talking. I'm going to post a few bit of event, stuff into the group chats, but I'll post a link to that event. You need to register for it like you did this one. And what it is, it's called Bridging the Gap. It's helping realtors understand assignments of contracts. For those of you who do wholesale deals and you assign your rights in a contract to another investor, if you want to learn about how to work with realtors, or if you're a realtor and you've been seeing stuff like assignment of contract transaction or contract for sale or the word wholesaler, and you want to learn more how you can make money by working alongside that investing strategy, this is a good webinar. We've done it before. It's going to be myself. It is going to be a realtor who's also an investor. And then it's going to be my attorney. And we've done this before in front of a lot of brokers and realtors. We have the LREC has, we've got some statements from them. So long story short, tomorrow, if that's something that intrigues you, that will be another Zoom one. If I can live stream it, I will, but I'll make sure to have a playback video if I can't live stream it. So that's called Bridging the Gap. Again, I'm gonna put in the comment section the event details for that one. That's tomorrow with at 10 a.m. and that's gonna be Sharon Rock is the realtor working with us, and then Fleur de Lis Title, the attorneys there are gonna be helping talk about the legality of it. So with this, guys, a few more announcements is these events, guys, at the end of the day, REIA events, we want them to remain free, and I don't see that changing. That's actually been my goal from the very beginning, is that they're free and that we're able to give as much quality content where we're not pitching anything. We're not saying, hey, you need to do this course for X amount. The goal is content, content, content. And so that people can find ways to take action to get closer to their real estate investing goals. And so with that is we do have some local sponsors. A lot of times you guys ask me, these are actually people who I would recommend in the first place. And so I'm going to put the link so that for those of you who are asking, but we've got sponsors, like we've got the last webinar we just did was on how COVID-19 is affecting the real estate industry. So I brought on like Christina Rusca, who's a lender, and she talked about how COVID is how it's affecting the lending atmosphere. We brought on Fleur de Lis Title. So Jared Miguez with them, he talked about how is it affecting their closings and their title company. We had Justin Harris, who's a land wholesaler, talked about his deals. We had myself, I talked about my flips, I talked about my wholesale deals, I talked about different deals that I was working, how it's affecting my company. And by affected, guys, we're talking positively or negatively, right? So then we've also got, we had Haley with Quest Trust Company, which is an IRA, a self-directed IRA company. They shared about how it is affecting them. We had Bob Norton, who talked about the SBA loans. He talked about the deferment of taxes, like the timeline getting pushed back. So we had Ryan Cartier, who's a contractor. He talked about that division. And then we had Wayne Sanji, who is not only is he a broker, but he is a property manager. They talked about how they're, as a landlord, what they were seeing. And then Mia Rogers, who is a realtor, has well talked. I think that was just about everyone who shared. But if you guys can see, it was a lot of parts of the industry. So if you didn't watch that yet, that's worth going back to see. Lastly, so these sponsors, guys, if you are looking for just to maybe see if there's someone who would be a good fit, these people are investor friendly. They're worth checking out. Specifically, I know a ton of you have been asking me about the SBA loan and asking questions. Honestly, guys, Bob Norton, he is a real estate specific CPA. He is a great asset. Actually, Bob, can you put into the comment section the number people can text you for free information on the SBA loan? Because he's the person I've been pointing people to, because not only is he a real estate specific CPA, he is a broker and he is an investor himself. So it's definitely something that you want to take a look at. He just put it on there. Text disaster to 985-244-3944. You don't have to be in Louisiana to work with him, but no matter what, he's given out some free advice on the SBA loan. I know there's a lot of moving parts. Trust me, I've dealt with it in my own business. So lastly, guys, before I get going to bring on Brady, I want to talk a little bit about webinar etiquette. I have you guys all muted on purpose because we just want to limit the amount of distractions. And so that is one of those things where if just hey, look, webinars and Zooms, they're an art. I don't know if you guys have been seeing the memes going around of people forgetting that they have it on video and they accidentally like go to the bathroom or something while they have it on video. So you might also want to go ahead and take off your video as well. So we've muted you guys for a reason, but that doesn't mean we don't want you to interact. So not only do we have it in the Facebook Live, but in the Zoom, there are like a chat section. So if you have questions, I'm going to be monitoring those. If you have questions for Brady or myself, go ahead and text them in there. And I'll every now and then I'll try to bring those up to you, Brady, so that you can see those and hear those. But so guys, if you really want to pay attention where, if you're on Facebook Live or if you're on the Zoom, you want to be looking at the chat part. Guys, lastly, I'm going to bring on Brady next, but at the very end is I'm going to give a really like a real estate specific way of viewing what he just shared. Brady's going to give an economic look at all of this. And on the back end, I'm going to tie real estate investing in with it. Okay. So stick around for that. And if for some reason you did not, if for some reason either if the Facebook Live goes off or whatever, I will upload the recording of the Zoom. Okay. So if you have to leave or whatever, you should be able to watch it. You can come back to our Facebook page and replay it. Okay. All right, guys, without further ado, I'm going to go ahead. I don't know, Brady, I think it was in January or February, I met you at the Hattiesburg event that my friends Adam and Brent put on. And I've heard a lot of people share about economic trends and just things in general. But Brady did a fantastic job of taking a bland topic and really bringing it to life. So this is a great opportunity. I immediately was like, hey, how can I bring you to this group? And so what I want to do is he's going to be doing some screen sharing so that you can see what he's talking about trend-wise, graph-wise, and everything. And he's going to be bringing a fantastic look into it. Guys, this is a question I know almost everyone is wondering right now what is the market doing right now? Now, you're not going to get a very conclusive answer from him, but you will be able to see data. And that's something that he brings a great point to. And the goal is to be able to have getting informed yourself so that you can use that when making decisions. And so without further ado, Brady, if you want to come on, if you want to introduce yourself in the beginning and kind of go from there, okay?
Well, thank you, Courtney. I appreciate that. I appreciate everyone taking the time to join us this evening. So yeah, as Courtney mentioned, I'm in Mississippi. I am a financial advisor and I'm the director of investment strategy for an investment firm in Mississippi. So I'm a chartered financial analyst, a certified financial planner, and a chartered market technician. So I enjoy the economy. I enjoy talking about it. And so I really appreciate the opportunity to share that now. In fact, let me go ahead and do a screen share. Let's see here. All right, can everyone see that? Good deal. So we are going to take a look at just what's going on in the economy. What's going on in the world. I'm going to try, as Courtney mentioned, I'm going to try to tie this to real estate as much as I can, but I'm not a real estate professional, nor am I really a real estate investor, although I've dabbled here and there in rental properties fairly unsuccessfully through the years. So, without further ado, let's launch in. And feel free, if you have questions, put them in the chat of the meeting, or feel free to ask them on Facebook, and then we'll get to those as we go. So, part of what I do on a regular basis is talk about risk. A lot of the investment landscape, a lot of our discussions focus around not so much how much money will this investment make us, but more about what's the downside. If we're wrong, if this is wrong, what's the end game? And so really in the real estate world, there's three broad categories that we see, at least, of risks. On the far left-hand side of your screen, there are risks that you can control on some level. You can control the price you pay for properties. You can control the valuation that you're getting whenever you buy a house, whether that be a rental home or a flip or whatever. You're in control of that. You can have assessments done to make sure that home, that real estate purchase, that they're structurally, it's sound, that you're not buying a home with a bunch of termite damage and that kind of thing. There is a risk of the title, but you can get title insurance. You can do background work on the title. On the far right-hand side of this, there are things that are act of God things. There are risks in real estate that involve natural disasters, hurricanes and earthquakes, and that's exactly why we buy insurance on our properties. But then in the middle, there are risks that we can't insure against and that we have no control over. And these are the risks that we're going to really talk about today, specifically this one, the recession risk, which by all, by all metrics in the economy, we are currently in the middle of a recession. I don't think there's any real debate to that. Now, the only possible debate that you may see back and forth is technically a recession is 2 consecutive quarters of declining GDP, basically a shrinking economy for 2 consecutive quarters. It kind of remains to be seen if we'll see 2 quarters of declining economic growth. I think we will, but nevertheless, for all practical purposes, what we're feeling and what we're in right now is a recession. Now, it's sort of a homegrown recession that we threw ourselves into for the sake of the health of the country. Nevertheless, it's going to look and feel a lot like a recession. So that's where we're going to focus most of our energy. The question that we now have to ask is, now what? The economy is tanking. What does that look like? What do we do? How far and how deep does this recession last? Well, let's look at some numbers. First, I think it's important to go back and look at the most recent recession as sort of a framework for this discussion. So I don't know how many of you were real estate investors or involved in real estate in 2007 and 2008, 2009. So some of this may be really familiar to you. But on the top left-hand corner, the unemployment rate during the 07, 08, 09 timeframe basically doubled. We hit north of 10%, almost 11% unemployment in the country. Bottom left-hand corner, the total economy contracted by almost 5%. That's a dramatic contraction in the total economy. We had massive layoffs, as you can see in the month of February of 2009, over 300,000 mass layoffs and unemployment claims. 3 million homes were foreclosed on. And then, as I know, most of my expertise is around the stock market and investing in publicly traded securities. 2007, 2008 was an absolute disaster. The S&P 500 declined almost 60% from top to bottom, from October of 07 to March of 09. It was sort of a bloodbath all the way around. And so now let's take a look here at what I'm calling the 2020 edition of this, just for a frame of reference. So if you'll focus on the bottom left-hand corner, in 2007, 2008, GDP contracted by 4%. Goldman Sachs right now is forecasting that in the second quarter of 2020, we're going to have a 24% contraction in the overall size of the economy. That's not a typo. They're also forecasting that unemployment will go from a record low of 3.6% to 15%. That's actually on the slightly lower end of some of the other estimates that we've seen. On the top of this chart, in the month of February 2009, we had 300,000 layoffs. In the last 2 weeks, we've had 10 million people file jobless claims. That's staggering. That's staggering on a level that basically the economy is shutting down on an epic scale. And we know that. We feel that because we're all sitting at home and likely not working the way we're accustomed to working as well. What we don't know are the answers to this question. How many homes will ultimately be foreclosed on when all is said and done? And what will be the top to bottom decline in the S&P 500? We don't know. And so that's what remains to be seen in all of this. But let's look a little specifically at what is being dramatically impacted. What's at the eye of this storm? Well, first, let me say this. Back in 07, 08, whenever we saw this contraction, we saw a dramatic decline in the number of single-family homes that were sold. Now, admittedly, 2006, 2007, we had this massive buildup. After the dot-com bubble burst, we took we took interest rates down incredibly low. We had this massive real estate boom that was largely unsustainable. And so the magnitude of the decline of new home sales is probably not going to be repeated. But nevertheless, I think it's safe to say we will see a dramatic decrease in new home sales over the next 3 or 4 months. For one, people just simply aren't leaving their house. And for two, there's just fear. And when there's fear, people don't want to make decisions. There's uncertainty in the market, and so people choose to sit it out and wait. Now, let's take a look at the epicenter. What are the industries that are most impacted by what's going on right now? If you look on the right-hand side of your screen there, you can see that the biggest industries that are impacted are hotels and tourism industries, obviously the airline industry and cruises, entertainment, which would fall into even sporting events and Major League Baseball and all the things that we're not getting to enjoy right now. Restaurants, bars, and then just the retail industry in general. Think of any department store ever. Now, to put this into perspective, those industries make up roughly 20% of the entire economy and roughly 20% of all payroll jobs in the country. So a huge portion of the economy is at the epicenter of this crisis, completely shut down. Now, the one industry that's not included in this, and it's probably very apparent to you guys being in Louisiana, is the oil and gas industry. They're not necessarily at the epicenter, but they are being contracted tremendously, massive layoffs. As you know, oil and gas prices have fallen. If we include the oil and gas industry into these numbers, then we're darn near at 30% of the entire economy, and 30% of all employment in the country is basically at a total and complete standstill. It's at a halt. Speaking specifically about oil and gas, let me backtrack for just a moment and say this. The last 3 or 4 years, we've seen a dramatic shift in the oil and gas world. The United States has increased their supply and their output of how many millions of barrels per day they're flowing through into the rest of the world, and that has put a hurt on OPEC. OPEC is the oil exporting countries of the world, and so a lot of these countries, think of Russia and Argentina and Venezuela and Saudi Arabia and Iran, these countries rely on oil and gas exports to fund their government. And so as the United States has dramatically taken market share and increased their production, it's put a tremendous strain on a lot of these other countries around the world. And so about 3 weeks ago, OPEC decided, Russia and Saudi Arabia specifically, decided to wage war on the US shale industry with threats of price decreases and production hikes, coupled also with the obvious fact that no one's traveling, no one's driving, and no one's flying right now, has been just a meltdown in the price of oil. As you can see here on this chart, a barrel of oil on March 31st of this past year was at an 18-year low point. It was trading at the exact same level that it was in 2002 at a little bit more than $20 a barrel. Now, things have picked up in the last few days. Rumors of a deal, perhaps rumors of production cuts. The price of oil has jumped some, but it's still well below any oil company or the oil industry in general that could be profitable at these prices. And so what we're seeing is more and more workers being furloughed and laid off. And so we're seeing big contraction in the oil industry, not specifically because of coronavirus, although that's a huge factor, but also because there is unrest in the major players in the oil market. As long as oil prices stay depressed, this is going to continue to be a drag on employment and on those companies and unemployment specifically. So the question then arises, what is this? Is this a depression? Is this 2008 all over again? Is there a light at the end of the tunnel? In 2008, a quick history lesson. In 2008, we had a chairman of the Federal Reserve, a guy named Ben Bernanke, who took some pretty drastic measures. But first, let me tell you a little bit about the Federal Reserve in general. The Federal Reserve is an organization that is tasked with two things. They are to maintain price stability, meaning they try to keep inflation low, and they are tasked with maximizing employment in the country. They do this through a variety of mechanisms. They can do this by increasing or decreasing interest rates. They can do this by providing liquidity through the asset purchases in banks. They do this by printing money. The Federal Reserve has a handful of mechanisms at their disposal that they can use to try to stimulate the economy and make things go quicker, or they can try and contract the economy and slow things down if they feel like it's getting overheated. Well, the decision makers, by the way, there are 12 regions of the Federal Reserve. And each of these regions has a decision maker that basically sits on this board of directors. And they're these smart people sitting in a room making decisions about what they're going to do with interest rates around the country. In 2008, the chairman of the Fed was a guy named Ben Bernanke, as I mentioned, and he had written a book on the Great Depression. He was a student of the Great Depression from the 1920s. And Bernanke had come to the conclusion that the problem and why the Great Depression really escalated, and the problem with that was there was not ample liquidity in the system. The Federal Reserve in the 1920s did not do a good enough job of pumping money into the banks. And so there was just simply no loans to go around, and there was not enough money available to re-expand the economy and get them out of this problem. A sidetrack here. A recession is simply caused when people stop spending. Roughly 70% of the entire economy is consumption. And so when people stop spending, the only way out of a recession is to get someone to start spending again. It can be the government that starts to spend. It can be consumers who begin to spend again. But some way or another, someone has to spend money. And in order to do that, the Federal Reserve has to provide liquidity. They have to provide money and the ability for these companies to have access to credit so they can borrow and spend as need be. So in 2008, 2009, Ben Bernanke got a nickname as Helicopter Ben. He took this to heart. They began pumping money into the economy. The joke was that they would literally fly over in a helicopter and drop money. Of course, they didn't literally, but what they did do was they took the balance sheet of the Federal Reserve over $2 trillion. I won't get into the real nuts and bolts of what that looks like, but I will say this. Essentially, the way to provide liquidity that the Feds chose in 2008, 2009 was a asset purchase program named TARP, the Troubled Asset Relief Plan. And they would purchase bad loans from banks. They would basically trade cash to the banks in return for these bad loans that they had made. And these loans would sit on the balance sheet of the Federal Reserve. Now, what happened was the banks suddenly now had money they could lend again. And this kept, basically greased the wheels of capitalism, and it made sure the banks weren't running dry. They did another thing. They decreased tremendously. The Federal Reserve controls something called the Fed funds rate, which is the overnight lending rate amongst banks. They can lend money to and from banks, and for a long time, that interest rate was historically around 3 or 4% in the country. In 2006 and 2007, it got up to 5%. The first thing the Feds did at the first sign of the trouble, as you can see here on the graph, was begin to cut interest rates. They had emergency meetings where they would cut interest rates down to the 0% range in late 2008, early 2009. And it stayed at that 0% boundary for a long period of time. We didn't see interest rates begin to rise again until about 2017. And so these are the two main mechanisms that the Federal Reserve has. They can provide liquidity and make sure that the plumbing in the money system is working and flowing, and they can cut interest rates. Now, this does two things. When they cut interest rates, it incentivizes borrowing and it punishes saving. Now, they may not say it that way, but suddenly the CDs or the savings accounts or the money market accounts that you have at the bank aren't paying 3 or 4%. They're paying basically zero. And so it encourages people to spend money and get their money off of the sidelines, and it encourages risk taking so that people will begin to borrow money again, and companies can expand and people can purchase real estate, that kind of thing. All of this that we're covering happened already in 2008, 2009, okay? Today, we have a chairman of the Fed, a guy named Jerome Powell. Now, Jerome Powell is very much of the exact same line as Ben Bernanke, and he is following the Ben Bernanke playbook to a T. This is what the Federal Reserve has done with their balance sheet just in recent months. This, by the way, is 2008, 2009. This is the graph that I just showed you on a smaller scale. Over the course of the last 8 years, we've still had the Federal Reserve providing money to banks and pumping that in. But this is where we are currently. Just in the last 30 days, the Feds have increased their balance sheet by $2 trillion. That means they've pumped or provided liquidity to lending institutions to the tune of $2 trillion into the economy. Now, the way they're doing that is by purchasing things from the banks. They're trading cash and they're buying assets. It could be corporate bonds, it could be mortgage securities, it could be anything. They're literally purchasing it all. They came out with a press conference, I guess about 2 weeks ago now, and basically said, we will do whatever it takes to keep the economy afloat. We will pump money in, and so that's exactly what they're doing. The other thing the Federal Reserve did was they followed the playbook from 2008, 2009. As you can see kind of in the middle of your screen, that decline, that sharp decline in interest rates was what I just showed you a second ago. Closer to the right-hand side, you can see that's been the playbook yet again. They've taken interest rates from about 2.5% back to 0%. Now, let me clear up a couple of misconceptions about the impact that actually has. First off, it has decreased the yield curve. What that means is if you go and try to buy a government bond right now, you're going to get incredibly low interest rates on your purchase of a government bond. In fact, as of the end of March, a 10-year government bond was paying 0.7% per year. So we've seen a dramatic decline in yields. Just 7 years ago, we had 3% yields on the 10-year, and now that's come down tremendously. There is talk that, how low can this go? Might we see negative interest rates in America the way we did in Europe? I suppose it's possible, but the Federal Reserve has said that that is not their intent. So let me clear up a couple things. The right-hand side of your screen, this is the Fed funds rate. This is the interest rate that the Federal Reserve controls. They don't control things on the right-hand side of your screen. Now, there is an impact. There's a filter through impact. When the Feds cut interest rates down to basically zero, in time, you will see the savings accounts and the money markets and the government bonds, you will see all those yields come down in tandem with that Fed funds rate. The one thing that you may not see is the cost of borrowing change all that much. In fact, if we take a look at the mortgage rates, when the Feds cut interest rates dramatically a few weeks ago, the cost of 30-year mortgages actually spiked, which was surprising. As you can see down on the bottom right-hand of your screen, the 30-year mortgage rates actually spiked to 4%, despite the fact that the Feds cut interest rates so dramatically. Now, why? Why would this be the case? Why would mortgage rates spike when the Feds cut interest rates? It's far more than just simply an announcement that the Feds are going to reduce rates and all the other rates follow along with it. Mortgage rates have their own internal market. This is a chart that shows the value of mortgage-backed securities. Now, these are commercial loans, not residential loans, but data on that was slightly easier to come by. And as you can see, just in the last few weeks, we've seen a dramatic decline in the value of mortgage-backed securities. Essentially, few people right now really want to own mortgages of commercial properties or residential properties for that matter. Everything that we talked about in the beginning, the fact that we're heading quickly towards 15% unemployment rate, and we're going to see massive job disruptions in a lot of industries, people know this, and they want to be compensated if they're going to own a mortgage, if they're going to be, if they're going to invest in mortgage-backed securities, they're going to want to be adequately compensated, and they're not willing to take a lower interest rate, despite the fact that the feds are cutting interest rates. And so that's why we've seen mortgage rates not follow the Federal Reserve Fed funds rate. When they cut rates, mortgage rates did not do the same. Let me explain for just a minute, and I'll try to keep this simple, exactly how the mortgage-backed security world works and why that matters if you are a borrower and a real estate investor. So traditionally, if you're a borrower and you're going to buy a piece of property, then you need cash to buy that property. And so you go to a lender and you exchange basically the promise of future payments in return for present day cash right now. That lender turns right around and sells or trades a basket of mortgages to Fannie Mae or some other government agency in return for what's called a mortgage-backed security. If you watch The Big Short in 2008, or in the movie, I guess it came out in 2012 or whatever, but it was about the 2008 mortgage meltdown. The Big Short dealt a lot with this. Essentially, these lenders sell their mortgages to Fannie Mae. They, in return, get mortgage-backed securities that they then sell off to investors. The investors are pension funds, insurance companies, mutual funds, other banks, etc. Okay, so this is sort of a simplistic but traditional way the piping and the plumbing works when it comes to real estate and real estate financing. Okay. Now, this all works fine so long as the borrowers are paying their money to the lenders, and the lenders are now able to make payments to the investors through these mortgage-backed securities. But when the flow of funds is cut off from the borrower to the lender, suddenly there is mass panic from the investor. The problem also lies in the fact that the lender has made promises to make these payments regardless. And so even if cash flow is not coming in from the borrower, these lenders who are making these payments to the investors are still on the hook for that. And so when this cash flow goes away, the lender is also still required to make payments. And that's when this could become something like a 2008 real estate crisis if the government doesn't step in and continue to provide liquidity, continue to purchase these mortgage-backed securities. And so that's why I bring up the idea that the plumbing of all of this matters tremendously in keeping liquidity flowing to the real estate market, which is what you all need as real estate investors. Which brings up another question: will the government save us? Are they doing enough to keep this ship afloat? Believe it or not, the short answer may be yes. The government is doing a lot. They've provided about $6 trillion of liquidity in a variety of different ways. I already mentioned what the Federal Reserve was doing, how they're providing liquidity into the market. But beyond that, the government imposed a few things. They passed the CARES Act. I won't hit on all of the topics in extreme detail, but I did want to focus on a few of them. You've heard a lot about the cash payments, the fact that the Federal Reserve, excuse me, not the Federal Reserve, the Treasury Department is going to be mailing Americans checks. They're going to be deposited to the tune of $1,200 to $2,400, and depends on your income level. That will be helpful. That will mostly just keep people afloat. They have improved their unemployment benefits. Again, that's helpful, but it will likely keep people afloat. A quick aside: they have improved their unemployment benefits so much that it may actually be somewhat difficult to re-engage the employment market if they're trying to restart the economy in 30 days. If you're a waiter at a restaurant, you run the possibility that you're going to make more money for the next 3 or 4 months by sitting here being unemployed than you would be by going back to work. Who knows? We'll see if that's a strange unintended consequence of trying to restart the economy that may actually delay things, but we shall see. Nevertheless, it was probably the right move. They are providing small business loans through the SBA. This is the the Payroll Protection Act, and there's other various loans. Some of those are going to be forgivable. Again, that's a little beyond the scope of what we're talking about here. They put an eviction moratorium on certain HUD properties. Look into this if you are a real estate investor. I'm sure you already have, but if you're a real estate investor that owns HUD properties, there are certain restrictions now on who you can and can't evict and how long you have to give people time to pay rent. So be careful with that. They have also allowed for retirement account withdrawals. You can effectively withdraw to $100,000 from retirement accounts and have 3 years to repay that money into the retirement account before it's taxed or penalized. And so that could be a helpful way to float yourself. Now, keep in mind, I would not do this unless you absolutely need to do this, because that's one more liability. If you pull money out of your retirement account, yes, you have 3 years to put it back. But if you don't put it back within 3 years, you're going to be taxed and penalized and all that. And so unless you are in dire straits, I would not recommend doing that. The other thing that they have allowed for is mortgage forbearance, and there are certain tax benefits. Let me focus on the last two, though, a little bit more. The mortgage forbearance is interesting. If you have a mortgage that is a federally backed loan, then you can request mortgage forbearance up to 180 days without fees, penalties, or interest other than that accumulates naturally. And if needed, you can even get an extra 180 days. Now, there's a handful of requirements if you're a real estate investor, but it's even possible if you own multifamily rental properties. You have to be current on your mortgage as of February. And if it's approved, you can't evict tenants from your properties, nor can you charge them late fees. Again, this is not my forte specifically, but this is pretty interesting. What this is also doing, though, potentially, is having some strange unintended consequences. If you think about the fact that, yes, this is providing direct relief for people who hold these mortgages, what it's also doing is starving the banks of cash flows. It's starving these investors and these companies that have these mortgage-backed securities. There's suddenly a tremendous lack of cash flow on these mortgages. Now, again, not a bad move from the government. They're doing this to help people pay their mortgage. But the flip side is, for investors, it is drying up the appetite of anyone who would want to buy or invest in mortgages right now. And what that does is it changes the risk appetite for lenders. And so if you are trying to sell a home that you have just flipped, suddenly this is a problem. If that purchaser is going to get a mortgage and the appetite for mortgages is decreased, it can put a damper on the mortgage market in general. Now, a tax benefit, though, and I would encourage you to either screenshot this, take a photo, or I'll be glad to email this out later. But Google and read about the tax benefits for those who are in the residential or commercial real estate market. If you're self-employed or even if you're a real estate agent, there are a lot of different things you can do as far as deductions go. Suddenly, you can defer some of your self-employment taxes. You can reclaim depreciation on certain assets that you couldn't before. You can delay the payment of payroll tax, et cetera, et cetera. You need to talk to a tax professional, of which I am not, but you need to talk to someone to understand the tax benefits that are now available through the real estate market. And so I would encourage you to do that if you haven't already. All right, what now? What can we expect? I just hit you with a whole lot of information, but what does the future look like? How quick is this recovery going to be? When is the country going to, quote unquote, get back to normal? When are people going to leave their houses? And when they do, how quick are they going to travel, go to hotels, and do all the things that we are accustomed to? More personally, on a concerning level, what about restaurants in our little, small area here? There's a lot of friends. I'm sure you have friends. I have friends who are restaurant owners. how long can they pay their bills without any source of revenue whatsoever? Is the government going to do more stimulus to help all these different industries? I think the short answer to that is absolutely yes. They're going to have to continue to do this. Every day that the economy remains, quote unquote, shut down, it's putting more and more stress on people to pay their rent and pay their mortgages, and for the unemployment rate to get worse and worse. So I think we are definitely going to see more stimulus. The fear, though, is what happens if we reopen too soon? If suddenly the economy decides, if our administration decides, hey, you know what, things are looking good, we have shrunk the curve, we need to go ahead and reopen the economy in 2 weeks. What are the odds that we have another round of this where suddenly the rate of infections and spikes again, and we have to re-shut down for a period of time? That would kind of be a worst case scenario. And then what are other industries that may be impacted? Again, let me focus some on the final two questions. This is a busy chart, so I'll give you a minute to process this, but this shows in 1918, there was a flu pandemic. And each city did their own thing. There was not a uniform effort to shut the country down the way there is now. But each city did some form of social distancing, as represented by the little kind of pink-looking bars. Okay, so as an example, the top left-hand corner, Philadelphia, Pennsylvania, had a dramatic increase in their death rate. They shut the country down, and their death rate fell, and so they were able eventually to come out of isolation. New Orleans, over just a little bit, and San Francisco and Denver apparently came out of their little self-quarantine too soon. Their social distancing efforts weren't adequate, and they had, I guess, what you could refer to as sort of a camelback response to this flu pandemic in 1918. The fear is that we all look like, I don't know, Denver, sixth one over, Denver, or Birmingham, Alabama, or Omaha, Nebraska, or Spokane, Washington, or Portland, Oregon, where we have this dramatic spike. We think it's okay, and then we have another spike because we've come out of isolation too soon. We've all celebrated the last few days, at least the stock market has, because it looks like we're slowing the curve. The unfortunate thing is it's only working because we're all in isolation. If suddenly we reopen the economy, there's a pretty good chance that we see another spike back in all of this. And so a little bit concerning there, but who knows? I would rather wait a week or two longer than we need to so that we don't have this spike and we don't have to do all of this all over again in August, but we shall see. Here's the other thing that sort of concerns me on just a broad economic standpoint. What you're looking at here is the percent of corporate bonds that are of the lower quality, okay? Roughly half of all investment grade corporate bonds right now are of low quality. What that means is corporations are not well prepared for this. They didn't have a lot of cash on hand. They haven't done a great job of paying down debt. In fact, debt ratios are relatively high. And so roughly half of all corporate debt that's outstanding right now in the investment grade space is of the lowest credit quality. That's not a great sign when you're going into a recession where companies are already fairly heavily indebted, as we see now. This could manifest itself in a lot of ways. It could mean that companies suddenly get in financial trouble a lot quicker than you may anticipate. Suddenly they're not able to pay their bills because they were already cash strapped going into this problem. It could also mean that we see a lot of downgrades. A lot of banks and financial institutions that are holding these bonds suddenly have value impaired bonds where the value of these loans are having to be written down, much like we saw in 08, 09. And these banks are showing losses. Now, they've changed mark-to-market accounting to a large degree, and so I'm not overly concerned with that. But there's a higher possibility, I guess, that we will see default, and that could just slow the economic recovery. Okay. Again, those are broad themes in the economy, but what do we see in real estate markets specifically? This came out today. This was a quote that caught my eye and I thought was interesting. I'm sorry, let me move my screen just a little bit. I'm blocking my own view here. Whoopsie. The mortgage applications fell last week as the economy weakened. Purchase activity declined again, with the index dropping 33%. The new mortgage applications are 33% lower than they were a year ago. There's less liquidity, there's tighter credits, the average loan size has declined, and so there is stress right now in the mortgage market. There's not a lot of numbers and charts to go by just yet. It's a lot of anecdotal stuff because it's all happened so quickly. All of this kind of freezing of credit has happened in the last 30 days, and so we don't have a lot of pretty numbers to show you. There's a report that Credit Suisse is a bank and a research company, and they came out they do a monthly real estate report, and this is what they're hearing and seeing from a lot of the agents on the street. The three things on the bottom right hand corner caught my attention as much as any. It says there's no inventory right now. People just simply aren't putting their house up for sale. They're waiting, and so they're seeing a slowdown there. This agent in Los Angeles said that credit lines have dried up, and they are getting killed with cancellations and having to refund earnest money. And then the final one, investors are just simply reevaluating their buying. They think the market's going to go lower, and so they've stopped spending. This speaks to what I think is sort of an underlying concern in general, a change in risk appetite. The last decade, we have seen investors be rewarded on basically anything they did. Stocks went up, real estate went up, bonds went up. The price of assets was going higher. A shock like this, even if it is fairly temporary, it can put a damper on risk appetite. And so there's a fair chance that what we see coming out of this is investors just aren't as quick to want to take those risks, whether that be through purchasing a second home or whether that be through a real estate flip or whatever. There's a fair chance that risk appetite slows, and I think that's an underestimated factor in all of this. We've already seen demand decline. This was also from that same report. It's a small decline, but nevertheless, you can see there on the far right-hand side, the month of March, we see investor demand decline some. So, okay, one of the ways to gauge what's going on in the real estate market is to look at publicly traded real estate. Private real estate, the data is slow, it's largely inefficient, it's regional. What's happening in Los Angeles doesn't flow through to what's happening in Hammond, Louisiana. And so one of the things we can look at is publicly traded REITs, real estate investment trusts. They had about a 45% sell-off from top to bottom. They've recovered some, but it was a very dramatic and quick decline. More concerning was mortgage real estate companies. There are a handful of companies that specialize in mortgages, reselling and packaging mortgages. From top to bottom, the value of those companies declined 73% in a matter of 30 days. That's unprecedented. That's shocking, to be frank. And so you can see a massive bottleneck and a massive concern right now in the fact that no one wants to own mortgages, and there is stress in the mortgage system. What's the best case scenario from here? I realize, by the way, I'm talking relatively fast, but I have a lot to get through, and so I'm coming closer to the end, and then we'll take questions. Well, what's the best case scenario that we could expect going forward? I'm going to equate this to 1987. Okay. In 1987, in the economy and in the stock markets, more specifically in the stock market, we had a really dramatic decline really quickly. We had a 34% sell-off from top to bottom in a matter of weeks. The market rallied, the market fell, the market rallied, but ultimately it was a fairly quick recovery that didn't turn into a recession of any substance. Technically, it didn't even show up as a recession in the economic data. Now, this scenario is possible. if we suddenly begin to get the economy restarted, people get back to work, and the unemployment rate goes from 15% back to 7 or 8% relatively quickly, then what we may see is a fairly quick, what we would consider a V-shaped recovery, where things plummeted and things rallied. I think the more likely scenario is something more of a U-shaped, where it takes time. One of the best ways I've heard it described that I thought was fairly interesting is a sharp decline is kind of like turning off the light switch, but when we turn the lights back on, it's more of a dimmer. We're slowly turning the lights back on, and it might be a regional thing where certain areas of the country reopen for business, but large swatches of the country remain closed for some period of time. Nevertheless, what's the worst case scenario? The worst case scenario, based on everything I've just described, is that we reopen too soon, that we have to go back into shelter, the mortgage market, that the government doesn't do enough to shore up the mortgage market, lending contracts, and we have this really, really frustrating series of optimism and pessimism, and ultimately we just keep trending lower. This was 2000 to 2002 when the dot-com bubble burst. And it's worth pointing out that the real estate market and the stock market are very much connected. When stocks tank, it is zapping net worth. It is pulling money out of the hands of would-be investors and risk-taking individuals. And so when stocks tank, it is not uncommon to see other risky ventures slow. Generally speaking, if you have a lot of money, then you probably have exposure to the stock market and to the real estate market. And so those two are not isolated. 2008, 2009, we saw a 54% decline, 57% decline, from top to bottom, and a lot of, again, frustrating rallies and declines that didn't materialize. And so probably the worst case scenario would be Japan. 1989 to 1994, Japan had this horrible meltdown where basically everyone lost their risk appetite. The government had to step in and bail out companies and banks, and it created, I don't know if you've heard the term zombie banks, but created these zombie banks and zombie companies that were only functioning because the government was giving them money. But it just was this horrible, unprofitable time for roughly 5 years. And it took forever for the economy and the markets to recover. Now, again, this is doom and gloom, and I don't think necessarily that's what we're looking at here, but that's kind of your worst case. This is where we currently are. The stock market is a gauge of things. The stock market fell hard. It's recovered a little bit. The recovery, I would say, is due largely to the fact that the government is stepping up with various measures to provide liquidity, to provide money back into the economy, and to make sure that the markets are functioning properly. So, okay, I'm getting to the end. What should you do? You're a real estate investor in Louisiana, and I just hit you with all of this information. Specifically, what should you do at this moment? Remember, cash is king. Don't blindly take risks without knowing your liquidity situation. You need at all times to have assessed your liquidity needs. Remember, I'm viewing this from the mindset of a risk manager here. There are going to be opportunities. If you miss this opportunity, don't worry, I think there will be another. And so my advice to you would be prepared for those opportunities, but be patient, be selective with what you're doing, and know that we are in the very, very early innings of this. My personal opinion is this is not a V-shaped recovery where, doggone it, if you don't buy things in the next 30 days, you have missed the boat. My hunch is that we're going to see a continued stress in the system. These layoffs, this unemployment tells me that we're going to see more and more homes come on the market. We're going to see more and more distressed selling. The real estate market is unlike the stock market. Stocks can recover quick. Real estate has longer lag times for both falls and recoveries. It's a different market because it's less liquid. And so be patient, be prepared for those opportunities, and have a plan in place, but assess your liquidity needs. A shameless plug before I open it up to questions. I do have a book that I've written that has nothing to do with real estate, but it's just an interesting read on the backstory of the global economy. It's called In Light of Yesterday, and I'm thankful that it actually did make it to the top 10 in both macroeconomics and international economics on Amazon in a couple months ago. And so I would encourage you to check that out on Amazon. There is a link in the chat. And then finally, some coworkers and I do a podcast called Domino, where it's 20-minute episodes, and we look at some kind of an economic history thing, and we explore that. It's fun, it's catchy. We do fun sound effects. It's not dry and boring. So I would encourage you to check that out as well. So Courtney, if you want to open it up for questions or run with anything, we'll be glad to take a look at those.
Sure thing. I'm going to share just a few quick things, and then we'll open it up kind of jointly. So Brady made some excellent points there. One of the things I want to share is that, so here's just a few tips. I wrote down some notes, but as he shared, I don't believe this is like 2008. And a lot of people, that's the only frame of reference that they have, or maybe some of you in 2014 when the oil industry had issues in Louisiana, maybe toward Lafayette. This is not that. If anyone tells you, I know exactly what to do right now, they're talking out of both sides of their mouth, because no one, like, this is unprecedented, so no one has a clear crystal ball as far as exactly what to do. But so just be mindful of that. This is something where we're all doing our best to stay informed and using that information to help feed our actions, right? And help inform our decisions. So this is not 2008. Secondly, 2008, New Orleans was still in like a Katrina bubble or Katrina haze. So New Orleans also does not even have a true feel for what a recession looked like, because we were, as you guys know, prices went sky high post Katrina. So it's one of those things where when the rest of the country was having effects in the real estate market, at the same time, so many people were being displaced for a natural disaster. Like his very first slide talked about acts of God, and then the macro part of it, we had the unique situation where we had that act of God impeding on during, around the 2008 time. So just kind of keep that in mind. Lastly, a few other thoughts, guys. As he shared, we're not in the bottom of the market. A lot of people are, they think we're in the bottom of the market. They think all these things. First of all, the last presentation I saw at Brady, one of the things, Brady, you may be able to share the statistics on it, but most of the time, I think everyone's in agreement. As you said, we're in a recession, but most of them can't predict it correctly, even when you're in it,
Right.
as far as how long it'll last and things like that. So just know to be staying informed, stay connected. My goal with the REIA is to pump out as much content as possible for you guys, so that we can stay informed as you make these real estate decisions. And as he said, this is not, I don't believe it as well. I don't believe this is going away next week. I'm doing my best to be patient, to stay informed, and do a few things. Some of the things that I'm doing is I'm cleaning up shop as far as in my own personal finances, literally business-wise and personal-wise. Every expense is being questioned right now. Not because I can't afford it or anything like that, but because I want to make sure that liquidity, like he mentioned, you want to make sure you have available liquidity. You're not just frivolously spending. And so everything, literally print out one of your statements and say, okay, that was frivolous, that's necessary, that brings in profit, this could be replaced with something else. It's a great time to get caught up on your back end. While we're in a shelter in place, it's good to get caught up on that back end stuff, like filing for your taxes, get caught up on accounting, the paperwork stuff. Also a good time to get educated, like the stuff with the REIA we're putting out there and different things along those lines. Great time to read some books. But it's a good idea. Stay connected, know when to turn off the news. I prefer to read the news, not listen to it, things along those lines. But stay informed, stay connected with the local market. I'm going to put in there, we have a real estate investor group for the region. I do my best to share news articles that are helpful in that message. So whenever whenever stuff comes out, to share it in that group. So it has about 1,600 people from our region. I'll share that link in there. So stay in there. It's a great place to ask questions, or to share, news articles, or to maybe, get referrals, share deals, whatnot. But just lastly, you guys, look, buyers are still buying right now, and sellers are still selling. As I said the other day on the other webinar, was I just put a flip on the market, and last week I had 3 offers. Within 10 days of being on the market, I had 3 offers. Okay, wow. So people are still buying. I had previously, the week before, I had another flip close that was with a rural development loan, which is a government-backed loan. So a government product. Let me real quick share this. I was looking at a report earlier this morning that said in the greater New Orleans area, there were, in the last week, there were 220 homes were sold, 217 homes went under contract, 257 homes entered the market as new listings. So there's still a small amount of inventory. There's still people buying, still people selling. That is not necessarily stopping. People may think it's come to a full halt, but real estate transactions are still happening. People are still able. I haven't seen one real thing that's really dried up. So do your best. If you hear something, it's like maybe go ask 5 sources to see if it's true. Because, like, for example, some people thought the 203K loan had dried up, and then all of a sudden it was, lenders like, no, it didn't. So whenever you hear something, do some research. Don't just believe things on face value. Do what you can. So that's kind of where we're, one of the biggest things real estate investing wise, I'm going to say, guys, build some metrics for buying that is based around your investing goals, and also your experience level, and then your tolerance for risk, right? You don't want to be, for example, for some of you, this is probably not the best time to figure out how to get into a major rehab, right? Or something along those lines, or your very first, deal that has, maybe only $10,000, you would make it on the flip side. Well, $10,000 is really easy to switch profit-wise. This is a very small margin. So just some things on this, guys. Stay connected, stay informed. And so I just want to share that. Now, if you guys have any questions, I'm watching the chats on the Facebook Live as well as the Zoom. Bob Norton had one. He said, "Is there a foreclosure index?" Brady?
There probably is. I don't know. As far as I know, on the publicly traded side of things, I'm not familiar with it, but I would imagine that there is.
Okay. Anyone else? You guys got some questions? Look, for those of you who tuned in late or anything along those lines, this will be saved on the Northshore REIA the Facebook page. So you can go back and watch it. If maybe you said, hey man, maybe I want to watch this and pause or something like that, you're definitely welcome to as well. Who else has some questions?
Courtney, while you wait for those, let me just also echo one thing you said. I agree. I do not think this is 2008. I think the government learned some really valuable lessons from the 2008 fiasco. And so I think the measures they're putting in place now are very much to avoid a 2008 type scenario. I think that's a great thing. I think as much as I'm not a fan of socialism and massive government intervention, there are times I think when the government has to step in and do things, and I think they're doing that right now. And the moves they're making, I think, are going to help us avoid a worst case scenario where I don't think the banks are going to have this huge, massive liquidity crunch, and it's going to be impossible to get mortgages. I think they'll work those kinks out. And so I don't want to sound doom and gloom, because I'm truly not. But we are seeing a lot of stress in those areas right now, and so I'm hopeful that they will work that out. So anyway, that was my thought, just to echo what your point was.
So I know you mentioned that you were concerned about the unemployment. They're making it so favorable that there may be issues basically getting people back into that. One of those things is, have we experienced that in the past?
Not that I'm aware of. We have always had unemployment as a safety net. Well, I say always. I mean, in the last 70 or 80 years, we've had unemployment benefits as a safety net to help during hard times. But the fact that they've increased those benefits so much that you can get, I can't remember exactly what the numbers were, $600 a week more than normal, or whatever it is. The unemployment benefits are so favorable right now that unless you had a fairly decent income, there is some appeal to staying on those unemployment benefits. Now, I know they ramp off. There's a period of time, 4 to 6 months, that those benefits kind of go away. And so I don't think that it is going to, incentivize people to stay on unemployment forever, but it could be enough to kind of to slow the recovery, and it be more of kind of a U shape than a V shape. And again, that's me being a little cynical. I think more than likely, most people are going to happily get back to work at a high-paying job as soon as they possibly can.
So what would the ramifications of that be? Say that there is a percentage higher, like say that unemployment stays at a higher percentage than normal. What are the ramifications of that?
I guess just the tighter the labor market, the harder it is to find, obviously the harder it is to find quality employees, and the harder it is for businesses to get back on their feet quickly. And so it just kind of becomes a drag on the economy as a whole. It may not have much of an impact on the real estate market because dollars are still flowing, and whether that be from government unemployment benefits or actual paid employment, what difference does it make? If they're able to make payments, then they're able to make payments. But as far as just the broad economy is concerned, I could see it being a bit of a labor crunch whenever these restaurants and retailers decide to reopen. They may not be able to just simply snap their fingers and rehire whoever it was that they just let go.
So a few things that I've critically thought about is, one, could this change the landscape of employment in the future? For example, all these people working remotely, and basically all of these essential and non-essential, will this basically change some employers' way of having employees in the future? Either, hey, we could operate without them, or hey, we could, shoot, why do I need to rent a building if they can all work from home efficiently?
Right. Yeah, I think that's a great point. I would be a little nervous if I was in the office space, commercial office space world where I had a lot of commercial office buildings that I was trying to lease out. I think we may see it won't be overnight, but I think over the next, several years, we could see something of a shift that says, why am I paying for this office space? We could have, a meeting area and then work remotely and get things done. We're having those same conversations. Do we need to have an office? So I think that could be a stress in the long run as well.
So are we looking at what stressors are there potentially, or what indicators may be as places just to pay attention to for future opportunity? I don't wish harm on the economy or anyone at all, but just watching where there might be some bottlenecking, and say, hey, where might this turn? Like, for example, you were talking commercial real estate. They have those places where you can rent like a desk for the day, or like stuff like that, where it's not as long-term or as big as a commitment. I could potentially seeing stuff turn to maybe using more of that for like those meetings, like renting out an office room for the week, or just for a day or something along those lines. But commercial is one of the areas that I'm paying attention to. I'm very interested because, like, for example, right now, how many businesses have been shut down? I saw a video of a woman in Dallas, outside the Dallas area, who was a salon, so that's non-essential, and so it's been shut down with their shelter in place. Well, she went back and her landlord had changed to like an electronic lock on her door. Now, I'm not saying this is legal or not, but not only could she go in there and access her stuff, like she was having a hard time negotiating with the landlord on basically paying rent because she was making zero money. Right. And so the idea with this is how are commercial, so there's a lot of businesses that are struggling. And as you mentioned, businesses are currently not a lot, they don't have a lot of liquidity, a lot of cash reserves. So the question for that would be what would that look like for the commercial industry? I know I was reading an article recently, as an investor in general, would this be an opportunity to have liquidity to potentially buy businesses? Now, businesses and real estate are two of the main ways people have built wealth. I'm not saying just anyone go buy a business, but it is something to pay attention to.
Well, and the old saying that the best time to start a business is at the depths of a recession. Your competition is likely to be less, and if you have the pick of the litter of who you hire, And so I agree with you. If I could think of a great business to start right now, I might would. but yeah, the unemployment can be a positive factor if you are starting a business and looking to hire. You're gonna have a lot of people out there who are very well credentialed in whatever business you want to start, and you probably will have your pick of the litter of location too. I think we're going to be seeing a fair amount of buildings blowing in the breeze from restaurants that couldn't make it, or retailers that go under.
Sure. So these are some things that I'm paying attention to specifically. So commercial is on my radar. I'm not usually a huge fan of commercial, but being creative, because you don't want to necessarily repeat the person who maybe has to sell at a discount because he's not able to get certain people in that business for that building. You don't necessarily go by it and try to find the same clientele that they couldn't find before. You've got to be innovative and creative in that sense. Another one that I'm seeing is, you talked about the different industries that are being affected. And that's where the concept of looking for opportunity comes into play, right?
Yeah.
So for example, travel, Airbnb. I have a friend in the Bay Area, the Napa Valley Bay Area, who I think a few weeks ago, he lost $50,000 in Airbnb rental income from cancellations because he has a big portfolio. Airbnb is under fire right now from how, basically all the mass cancellations and what's going on, they're asking to be bailed out. So like hotels, bed and breakfasts, Airbnbs, I'm interested in what will happen to that real estate specifically. And maybe people who were over leveraged in the say their short-term rental that they bought. For example, there was some it was called, short-term rental arbitrage, where you would go and physically rent a house, and then that would allow a sublease, and then you go around and then do a short-term rental on it, Airbnb it. Well, then all of a sudden now you take away the Airbnb income, and all of a sudden now you're struggling to keep that rent. As an individual, if you take away all the cancellations, that's something that I'm paying attention to. So just in general, I think the pre-foreclosure, so I do a lot with pre-foreclosures. That one's going to be interesting to watch because of the moratoriums on foreclosures, that the courthouses are being shut down. The courthouses are having, there's that delay. What is that backlog going to look like? And what is it going to look like across the board? So it's a very interesting dynamic. So I'm looking at the potential with, it's really hard to iron that one out. These forbearances are potentially the unintended consequences with these. Post-Katrina, a lot of people did these forbearances, and then all of a sudden, the third month, they had a lump sum due. In Louisiana, it takes 120 days to file a foreclosure. So with the short term is a mortgage forbearance, the long term is a foreclosure forbearance. And so you're literally just delaying foreclosure by not, asking for them to pause it. So those are some thoughts I have. What do you guys, I see in the Zoom chat link, Bob posted a link for foreclosure trends. So those are going to be interesting. So one of the things there was two things I was talking about. I want to just have you respond to them, Brady, because as I'm waiting for some questions, last year, the government shut down for, what was it, a month, 2 months, or something like that at most?
Yeah.
And we saw that there were so many people who only had one stream of income, and who were so leveraged with debt in their life and basically living outside their means, that it was like people were one paycheck away from the food bank line. I'm very interested to see, because that was a very telling example of where America sits. Debt to income ratio, that this is why I think I agree with you on that U-shaped part. I'm by no means an expert, but I can put my ear to the ground and pay attention and say, I'm not stupid. A lot of people have credit card debt because swiping can't stop swiping. Then you got there's actually data on car loans, having issues with car loans, the student loan debt, medical debt, and then people who are buying outside they're living outside their means just in general. What are your thoughts on that? Because as far as that U-shape, no one can guess how long it'll take. My thought is, we're too early on for people to really feel the stress of it, because most people maybe could handle 1 month without an income. But when we start going past that, what do you
Yeah.
think?
Oh, I agree completely. I heard I listened to Bloomberg Surveillance, which is an interesting economics podcast, and they were saying that the real fear isn't the rent that was due on April 1st. The real fear is the rent that's due on June 1st.
Right.
Give it a few months, and then we'll begin to see some real cracks forming. The good news, the consumer on a debt ratio, thankfully, mortgage interest rates have been so low for so long that the mortgage debt isn't as big of a stress as it was back in the 07-08 timeframe, back when we had 6 and 7% mortgage rates. But you're right, to your point, the credit card debt, the student loan debt, the medical debt, all of those things, we have a very indebted consumer base in general. Mortgages may be the only area where we didn't have, comparatively speaking, a ton of debt relative to other recessions. Corporations, though, have done a horrible job of leveraging themselves over the last decade. The name of the game was borrow cheap and then buy back your stock with this borrowed money. And so they would borrow, and almost all the corporations, well, that's a really generic statement, but a lot of corporations are much more leveraged now than they were in 07-08 because interest rates have stayed so low for so long. You were almost foolish not to take advantage of the cheap money. And that's all fine and good until revenue goes to zero for months, and then you have a problem.
They talk about your burn rate, which is like your monthly, like how much it'll cost you to either live each month or for your business to run your business. Say it's $5,000 a month is what your burn rate is to keep your doors open. What if you have zero revenue? How many months of, reserves do you have? For example, landlords, let's say your PITI for your rental property is $1,000 and, rent's $1,500. So you got, $500 in gross cash flow that you can work with. How many months do you have of $1,000 in reserve to be able to handle covering that payment until you start having issues? And then at what point are you tapping into like money that you would have for repairs? Because what if there's an issue during that time with the water heater or a leak? Because the world ain't going to stop for an economic reason, right? So those things, so that's why it's imperative to have those reserves. There's a reason I have many tools in my tool belt to be able to buy houses at little to no money deployed. I have a lot of tools that I could use to where many times I've gotten free houses where I didn't have to bring anything to the table. I'm closing on another one next week. And so it's not that I don't have the resources to do that. What I'm doing is I don't want to outbuy my reserves. And what I mean by that is there's a lot of investors right now who have bought rental properties who did not have large reserves. And it's a lesson I'm learning because I've learned it the hard way is I want to make sure I'm building that reserves, which that takes discipline. You don't build up 10,000 in reserves and just say, "Ooh, I can use that to buy another house," but build that up because there is going to be a rainy day, and you're going to need that for, say, the vacancies and So, for example, if you are worried that you don't have the reserves right now, a lot of landlords are exploring that SBA disaster loan because if they can help put money back into, like, say, paying their mortgage. That is something to consider as a small landlord is considered a small business. It's something to, Bob, he put other in the contact part of the chat, he put a number. He'll give free information on that. It may be worth looking into that SBA disaster loan because you can look at, basically keeping your rental afloat while you may struggle to get rents right now. Like, for example, one of the things I was pondering was medical debt. So it's no secret that medical debt is high in America right now. And on top of that, just having insurance is very expensive. And then the cost of getting, medical services is very high. My thought is for all these people who are hospitalized due to COVID-19, what is that going to look like on the ability, like on the medical debt arena? I'm curious as what the unintended consequences with that. things along those natures, right?
Yeah.
Because there's not a lot of people who have, the normal person doesn't have $5,000 saved, right?
Yeah, you're exactly right. I mean, I don't know what the percentage is, but a huge portion of the country is paycheck to paycheck.
Sure.
And so even this government stimulus package where they're going to, provide $1,200 or $2,400 or whatever to everyone, I don't think this is a one-time thing. I think they're going to quickly see that they would be wise to keep this going for a few months. And so, I mean, that's purely a speculation on my part, but I would not be surprised to see this one-time payment turn into a few time payment, kind of a multi thing, just to keep the lights on. There are a lot of people who are going to go from nothing to something, or excuse me, from some paycheck to none. And even the people who don't get officially laid off, even people who just take a cut in pay or a number of hours, they're not going to be able to get unemployment benefits, but suddenly their cash flow is dramatically reduced as well. And I've talked to a lot of people who went from 40 hours a week to now they're going to be at 30 hours a week. So it's not unemployment, but their lifestyle is certainly impacted. So I think the paycheck to paycheck is going to come home to roost here. And so that's again kind of why I say the cash is king, and make sure you have liquidity. I think the opportunities are going to be plentiful over the next 6 months as far as scooping up attractive properties. It's a matter of don't overextend yourself and be patient of what you're actually getting into.
Absolutely. One of the things that Paul, he asked, I know you touched on it a little while ago. He said, how is a lender's ability to offer mortgages, how is it effective when security-backed investment contracts are still being paid while mortgages are unpaid, as well as bad debt increases?
So it's a complex little game. A lot of times the mortgage-backed securities, so the lenders are on the hook at a set interest rate. I'll just use big round numbers for ease. Let's say they got a $10 million mortgage pool and it's a 5% interest rate on that thing. The lender is on the hook to pay that 5% interest rate regardless of which cash flows are coming in or not from the mortgages. And so if effectively they're only getting half of the cash that they expected to get from those pool of mortgages, then the lender is on the hook with coming up with the other half out of pocket to pay the interest on these mortgage-backed securities that they've effectively, sold off or guaranteed or underwritten or whatever. And so that's where the strain can come into the financial system, if unknowingly, where the mortgage forbearance thing kind of has the unintended consequences. It's great for one side of the balance sheet for the consumers, but it can wreak havoc on the financial institutions that pay these set interest rates. And so that's where you can see the stress come in. So I don't know if that answered that question, but that would be my response to that.
So Paul said he's wondering if banks will have lower lending abilities when the economy returns due to large amounts of bad debt.
But perhaps the kicker is that the Federal Reserve, part of their multi-trillion-dollar asset purchase program is they're supposed to be purchasing this bad debt. That's what they learned in 2008, was to step in and buy these what they called toxic assets. They would buy these mortgage-backed securities that were failing and basically just swap cash to the banks so that the banks were stable. And my hunch is that that's what they'll do again, and that we won't have another repeat of a credit crunch. Right, the second, over the last 2 weeks, I think we had a miniature version of that. But I think it's a matter of time before the liquidity flows again and the feds are able to kind of put a Band-Aid on that.
So in the last webinar I did, where I had Christina Rusca, who's a lender, she shared how, if a lot of you guys saw, there was a mad rush, all these people refinancing whenever interest rates did some people called it a premature drop. And people were even locking in 2.75%, fantastic rates. Here's the thing is, people were going and doing these refinances, and it was overwhelming the industry. And what they saw was recently there was a spike in refinances. It was no longer those 2.75s. People were more in the 3 to 4% range. And that kind of varies. It's almost one of those things where Christina was saying, come back every day and check with me until they can lock you in. And they were no longer able to lock you in for very, very long periods of time. They could still lock you in, but just not indefinitely or 3 months or whatever.
Right.
But one of those things we were seeing was they changed like the credit, the minimum credit. They changed that. Certain lenders did. So for me, opportunity wise, it was saying, okay, if banks are struggling to lend or to a certain degree, or lending gets stricter, and so there's a smaller pool of people who will fit into that say frame of requirements. For me as an investor, we've got a property that I'm taking over creatively, and I'm looking, instead of keeping it as a rental, I'm looking at doing it on an owner finance, where someone will maybe put some money down and then be able to make monthly payments, and then over time be able to do a refinance. Because say, for example, right now they don't qualify because XYZ reason, or the banks are just tightening up. Let's let this breeze over for, in 2 years, and then we can kind of, they can refinance it then. That is something that opportunity wise I'm looking at. I'm not
smart.
rushing to do with every property. I'm just saying, paying attention and saying, okay, if a large amount of people are struggling with XYZ, is this something that I should educate myself on, and things along those lines.
That's a great idea.
But ultimately, people are talking about the housing crisis as far as banks having that. Basically, if a lot of people like don't make their mortgage payment, what do you, based on the data you shared a little while ago and things along those lines, what do you say if there was basically a large amount of foreclosures that come within the next 6 months?
Yeah.
What do you think right now? Obviously the real estate market wasn't like what it is right now, what it was in 2008. Two different real estate markets to compare to. We've got low interest rates now, things along those lines. But as far as if there was just a large amount of foreclosures going on, where on the other hand, last time you showed a graph on affordability, rental, like housing affordability.
Yeah.
So if the rental affordability is there's a crisis there, and if there's a crisis with, like, say, because people are over leveraged, or they loss of income, all of a sudden there's a lot of foreclosures, but at the same time they can't find affordable housing. Does that look like something where the government has to come in at another time, as that happens?
Yeah, I think so. But I also think there'll be opportunities in the rental market if you're able to work with people. I mean, you made a great point on the owner financing, but as people lose homes or whatever, they're still going to likely, live somewhere. And so they're going to need to rent something. And so whether that be, apartments or duplexes or, lower rent things, I think there will be opportunity for those investors who want to get into, maybe you haven't played in the rental market game. You may have your opportunity coming because there may be a higher demand for rental properties than there are for, the other areas of the real estate world.
So that is something that I'm going to type a few things into these chat rooms, but that you guys are looking at. So one of the things I was thinking was this might be a good opportunity to look at lower income. For example, whether that is getting familiar with, say, mobile homes, whether that's mobile home parks or just individual mobile homes, or it is things along the lines of maybe not the $2,000 a month, higher end home,
Right.
So that's something that there may be an opportunity there, just because of, for example, no matter what, people may be in a multi-million-dollar house, there's going to be a level of lifestyle that will remain. So there are some higher end properties that will get rented out, but it's just the renter pool will lessen, right? All right, you guys, I don't want to drag this out too much longer, but any other final questions? I put in the group comments, I put the Southeast Louisiana Investor Group. You guys are welcome to join that. There's some daily interaction there for like news articles, opportunities to learn, events, these future events, posting about deals, asking for referrals and things along those lines. I also posted in there, in March, I had Daniel Chadmore with Propello. He came and talked, and he gave a phenomenal talk about how to be a cyclical investor, meaning at the top of the market, he called 6 stages of the market. And at the top of the market, you're not going to be a flipper, and it's not best to be a flipper in every part of the market. It's, he kind of gave some insight into that. Probably one of the best as far as real estate wise to give a great talk. So I put that playback in the links. Lastly, tomorrow I'm hosting another webinar on, it's called Bridging the Gap. It's connecting realtors with how to work with wholesalers, and everything from how to stay compliant with LREC, the Louisiana Real Estate Commission, how to get paid, things along those lines, and how to understand it. Is it even legal? My attorney will be sharing. We'll have a realtor who will be working and sharing with us. So that's tomorrow from 10 a.m. to noon. The link is in the group. But any last final questions here? I don't think there was many, but I know this is something that you guys may want to go back and listen to and pay attention. But this is one of those things that is a phenomenal opportunity to really keep your ear to the ground and say, hey, what might be happening? No one has a clear, crystal glass ball, which I think they're going to be sharing here, huh?
Yeah, I would agree 100%. It's who knows? I think the idea is keep an eye on risk and keep understanding your own personal finances. Look for opportunities where they are, and then be patient. I think we're in the early innings. I think we have months ahead of us where there will be ample opportunity for real estate investors, for those who are patient and have the liquidity to do so.
Excellent. Well, Brady, I thank you so much for your time. I thank you so much for sharing your input and what you have, your experience shows. I'd love to talk to you coming back in a little bit down the road to be able to read, new data and use that. But for all of you guys, if you called in late or you want to rewatch this, go to our Facebook page for Northshore REIA, and I will be posting the replay video of this so that you can watch it, you can share it, things like that. Look, thank you guys. I hope to see y'all tomorrow. Thank you, Brady. It was a pleasure having you on.
Thank you, Courtney. I appreciate you. Thanks for the opportunity. Enjoyed it.
No problem at all. You guys have a great night. See you guys for tomorrow's webinar. Goodbye.